Look, I'm not going to sugarcoat this. The market's cracking in places. You can feel it. Prices are slipping, supply is climbing, and the word on the street is the market is crashing. But here's the thing. Calgary hasn't crashed. And until it does, I'm not going to hit the panic button. Today we're going to unpack what's really going on in our market, and I'm going to show you why the headline, "It's over" on my thumbnail, isn't what you think it means. Yeah, price increases are over for now, but is the opportunity over? Hell no. I'm also going to tell you who shouldn't buy real estate. Now, as always, before we dive into Calgary's numbers, we need to talk about the absolute dumpster fire that is the Canadian economy right now. Because if you don't understand what's happening at the national level, you won't understand why our local market is doing what it's doing. The Conference Board's Consumer Confidence Index fell 1.8 points in October to 46 points, continuing a troubling downward trend. And business confidence, it's at an all-time low. The Bank of Canada's Business Outlook survey found that only 13% of businesses are reporting labor shortages. Let me put this into perspective. That's the same share we saw in Q2 2020 when the entire world was locked down. It's tied for the lowest reading in 25 years outside the financial crisis. Businesses aren't scrambling to hire because demand is soft, and that filters directly into our consumer confidence. Now, you'd think with the economy this soft, inflation would be cooling off nicely, and it is cooling. Headline inflation came in at 2.2% in October, down from 2.4% in September. That's progress, and it's getting closer to the Bank of Canada's 2% target. But here's the problem. Core inflation is still sitting around 3%, with the Bank of Canada's preferred measures, CPI trim and CPI medium, hovering around 2.9 to 3%. And nationally, shelter inflation remains elevated because of high rents and mortgage interest costs, keeping overall inflation sticky. But Calgary's story is different. Here's where Calgary kind of diverges from the national picture. Our rental market has undergone a dramatic correction. After years of skyrocketing rents, Calgary's vacancy rate has surged from 1.4% in 2023 to 4.8% by late 2024 and into 2025. And that's one of the most dramatic turnarounds in recent history. And what's happening when vacancy rates jump? Rents fall. Canada's rents are down roughly 7 to 8% year over year. Landlords are now offering incentives, free months, waived deposits just to fill units. We've gone from a severe rental shortage to renters having options. Here's the double-edged sword for our market. On one hand, falling rents are great for affordability and help ease cost of living pressures for renters. That's good news for the economy. But on the other hand, when renting becomes more attractive and affordable, the urgency to buy disappears, especially for first-time buyers who are considering condos or townhomes. Why rush to buy an apartment condo when you can rent one for less, with more flexibility and without the maintenance fee? This is a big reason why we're seeing such weak demand in the apartment and row home style segments. Nearly 50% of all housing starts in the past year have been purpose-built rentals. We've flooded the market with rental supply, which has taken the pressure off ownership demand in the multifamily sector. And when you combine easing rents with 7.8% unemployment in Alberta and mortgage renewal pain hitting households hard, a lot of would-be buyers are choosing to stay on the sidelines. So while shelter costs are keeping national inflation sticky, Calgary's rental market correction is actually one of the factors weighing on our real estate prices, particularly in apartments and row homes and townhomes. And Canadians expect inflation to average 4% over the next year, according to the Bank of Canada surveys. That's well above long-term norms and considerably above the bank's comfort zone. Here's why this matters. If people fear future inflation, they spend more today. Why wait to buy something that'll cost more next year? Now, of course, you need to have money and a job to be able to do that. And just to pile on, we're dealing with this like double whammy, the US-Canada tariff war that erupted earlier this year, and the industrial carbon tax that keeps climbing despite what the government tells you. The raw materials price index is up 18% year over year, excluding energy. The government and their climate advocacy groups will tell you the industrial carbon tax has negligible impacts on prices, but that's bullshit. Here's what they don't want you to focus on. The industrial carbon tax is at $80 per ton right now, and it's scheduled to hit $170 per ton by 2030. And guess what? Even Mark Carney himself admitted that consumers are already paying more because manufacturers are passing those carbon costs down the supply chain. A Ledger poll found that 70% of Canadians believe industrial carbon tax costs are passed directly to consumers. And they're right. Then you add tariffs on top of that. Canada's 25% tariffs on the US steel and aluminum and auto imports originating from the US, which are still in place even though most other tariffs were removed in September, are hitting manufacturers hard. US tariffs on Canadian goods are doing the same thing. So manufacturers are getting squeezed from both directions, carbon taxes and tariffs, and you better believe they're passing those costs on. We're already seeing it. The Industrial Product Price Index, which tracks finished goods leaving manufacturing plants, jumped 0.8% month over month in August and is now up 5.5% year over year. This is what happens when the government tells you carbon pricing has no impact while your grocery bill, your utility costs, and everything else keeps going up. The costs are real, they're being passed down the chain, and Canadians are paying for it. Moving on, the job market is getting ugly. Canada's unemployment rate sits at 6.9% nationally, and here in Alberta, we're at 7.8%, one of the highest in the country. Employment insurance recipients are up 46% annualized over the past 6 months. This matters for real estate because job insecurity means buyer hesitancy, especially in Calgary's mid to upper price ranges. If people are worried about keeping their jobs, they're not rushing out to buy homes. The one bright spot, if you want to call it that, is interprovincial migration remains strong, which is still fueling demand in affordable and family-friendly neighborhoods. But I'm going to dive deep into the employment numbers and what they mean for Calgary's market in a separate video, so stay tuned for that. The economic growth picture is bleak. Canada's GDP growth in 2025 is projected at just 1.2%. That's barely above stall speed. We're essentially treading water. And for 2026, the Bank of Canada is forecasting just 1.1% growth. Let me put that into context. Those are sad numbers. Business investment and consumer spending are expected to remain soft for several more quarters. I've been hearing the word recession a lot. For Calgary specifically, this sluggish growth may keep some buyers and sellers in that wait and see mode, especially if economic confidence stays muted. But immigration and relative affordability keep Calgary more insulated than bigger urban markets like Toronto and Vancouver. The bottom line here is that the Canadian economy is struggling. Consumer confidence is shot. Businesses aren't hiring. Inflation is sticky where it counts. Spending is weak and growth is weak. So with all of this economic pain, what's the Bank of Canada doing about it? Well, they just cut rates again in October, their second consecutive cut, and their 9th overall since they began easing last summer. But here's the twist. Bond yields actually went up after the announcement. And why, you ask? Because the market heard Tiff Macklem essentially say, we're comfortable here for a while. In other words, the Bank of Canada is signaling they're done cutting for now, and the bond market agreed. Futures and yield curves are currently pricing in no more cuts in this cycle, that this was the last one. But not everybody agrees with that. Some economists, including Ben Rabideau from Edge Analytics, who, by the way, puts out some of the best housing market analysis in the country, still expects around 2 more cuts next year, probably starting late Q1. The reason being that the economy doesn't function well at current rate level, consumer confidence is very weak, construction is poised to slow sharply, trade tensions plus weak hiring make growth fragile. Personally, I think Ben's right, but The market isn't pricing that in just yet. So what does this mean for mortgage rates? Despite all of the rate cuts, 5-year bond yields are only about 30 basis points lower than the start of the year. So fixed mortgage rates are roughly where they started in 2025. Right now, the most popular mortgage product is the 3 to 4 year fixed, capturing about 43% of the market because it's kind of the Goldilocks option. Reasonable rate, less brutal penalties than the 5-year if you need to break early. Variable rates, though, are actually becoming more appealing than fixed. So we shall see. For those renewing this year or next, the reality is the average borrower renewing today and keeping their mortgage type constant is seeing roughly $105 per month increase per $100,000 originally borrowed. So if you've got a $500,000 mortgage, that's over $500 a month more. If you've got a $700,000 mortgage, that's $735 a month more. This is hitting wallets hard, and it's one of the reasons consumer spending is so soft. We haven't seen a rising payment cycle like this since the 1980s and early 90s, and if rates hold here, we'll still see payments increase on average $90 to $91 per month per 100K, borrowed right through 2026 before the renewal gap finally flips negative again in Q2 2027. It's important to note that the rates now are much more normal, so this shock really is because rates were ridiculously low before, not actually because they are unreasonably high now. Now, let's talk about the debt stress. This ticking time bomb. Many households are now renewing at rates 3 to 4% higher, percentage points higher than their original term. Think about that. If you locked in at 2% in 2020, you're now renewing at 5% or 6%. That is a massive payment increase. Although last I checked, Rate Hub, the best rate was 3.45% for a 5-year variable. The Bank of Canada's Monetary Policy Report notes that variable rate mortgage holders and fixed payment borrowers are under increasing strain. Mortgage delinquency rates remain low, but are slowly rising, particularly among younger households who stretched to buy in the 2020 to 2021 boom. Let's look closer at Alberta though. We have a higher share of variable rate borrowers compared to other provinces, which means Alberta is more exposed to payment shocks. While we haven't seen widespread distress selling yet, that risk increases significantly if job losses mount. This is something I'm watching very closely. Although for some, the most recent rate decrease could be a psychological turning point to get off the sidelines. I really don't think we'll see an increase in buyer activity though because of it. All right, let's get into what you actually clicked here for. We're gonna go over the stats for October real estate in Calgary 2025. So sales are down, inventory is up, and prices are falling. The media would have you believe the sky is falling, but let's dig deeper. Sales, yes, down, but not collapsing. Sales in October were 1,885. And yes, that's down 13% year over year. But year to date, we're at 20,082 sales, down nearly 16% compared to last year, but still in line with longer term trends. Here's the thing. Last year was bonkers. We were coming off a period of explosive demand driven by low rates and migration wave into Alberta. Now we're seeing the market normalize. Much of the decline in sales has been driven by pullbacks in apartment and row home style properties, which in most part due to improved rental supply and easing rents have slowed ownership demand in those segments. New listings in September were 3,233, which hit a record for the month, surpassing even the 2020 post-lockdown boom. Seasonally adjusted, new listings in October were down 0.9% month over month, but are still running about 9% above long-term norms. Let's talk about why supply is surging. Some sellers who waited for the spring that never came are finally listing. Survey data from the Bank of Canada shows a record share of Ontario respondents planning to list in the next 12 months. And while that's Ontario, we're seeing similar sentiment here. Distressed selling is picking up. More on that in a future video. Here's what's interesting though. Flat inventory levels alongside record new listings tells us there is a lot of cancellations happening right now. Frustrated sellers who expected a stronger fall market are pulling listings. We should expect that supply to reappear next spring. I am in this boat along with many of my other colleagues where listings are just sitting. Inventory is up 30% year over year with 6,471 units. We are sitting at the highest level we've seen in a while. But context matters. Months of supply is 3.43 months. Anything under 4 months is generally considered a balanced market. So while inventory is elevated, we're not in deep buyer's market territory across the board. Row and apartment condos are seeing elevated supply levels compared to demand. Apartments, especially sitting at nearly 5 months of supply, that is a buyer's market. And it's placing downward pressure on prices in those segments. But detached and semi-detached properties, they're sitting at under 3 months of supply. That's still relatively balanced. Now, what we all want to know is how sales, new listings, and inventory affect price. So here is the breakdown for the residential benchmark price per segment. Detached are at $744,300, down 1.3%. Semi-detached are at $683,100, up 0.9%. Row home, $431,200, down 5.6%. Apartment, $318,200, down 6.9%. So detached homes are down slightly. Semi-detached are actually up year over year, but slipped a bit month over month. And row and apartment condos are getting hammered. The divergence here comes down to supply and demand dynamics. Detached and semi-detached inventory is tighter. There's still demand for those product types, especially from families and move-up buyers. But apartments and row homes, we've got a glut of new rental construction flooding the market. Nearly 50% of all housing starts in the past year were purpose-built rentals. That's a record. And with student visa approvals way down, with dramatic drops in international students, enrollment at institutions across Canada, demand from international students who were a huge driver of apartment condo rentals has evaporated. So you've got oversupply in one segment and relatively balanced conditions in another. That's why prices are behaving differently. Let's talk about the district breakdown, okay? Where are prices holding up and where they are struggling? So Northeast, the benchmark price is down 7.8% year over year. This is the weakest district. City Center is down 576,700, down 3.8% year over year. The South is at 565,000, down 3.4% year over year. The West, 692,000, down 3.8% year over year. And the Northwest at 628,200, down 2.1% year over year. So they're holding out a little better. Again, it depends on the mix of property types in each district and the balance of supply and demand. Now, here's something I always track that I think is really important. The percentage of homes selling at or over list price. In a rising market, this is a signal of strength. Lots of bidding wars, lots of properties going over asking. But in a falling market, I almost think it's a sign of hope for sellers, because when only 58% of new listings are selling, that can feel discouraging. But let's look at the numbers. 6.7% of homes in October were sold over list price. 10.7% were sold at list price. So about 17.4% were sold at or over list price. Now, does that mean these homes were vastly underpriced? In some cases, maybe, but not necessarily. What it tells me is that there are still pockets of the market where we're seeing sellers' market conditions. Maybe it's particularly desirable neighborhoods or well-presented home or a property priced strategically to attract multiple offers. And here's the thing, it's not only homes fresh to the market selling at or over list. We're seeing homes listed for like 60 days still sell over list. You might be wondering, how does that happen? Usually it's because the seller does a price reduction either to where they should have been listed in the first place or into another pricing threshold that attracts a whole new pool of buyers. And suddenly they've got multiple offers. So if you're a seller feeling discouraged, don't give up. It's all in the preparation and pricing plan. Work with an agent who understands the data, knows how to position your home, and isn't afraid to have tough conversations about pricing strategy. All right, let's talk about the elephant in the room. Is it good that prices are going down. From a macro perspective, from a what's best for Canadians as a whole perspective, yes, absolutely. Affordability is a crisis in this country. The monthly mortgage payments required to buy a typical home in Calgary has come down significantly, and that's opening doors for first-time buyers who were previously priced out even just a year ago. And let's be real, the "you will own nothing and be happy" slogan is total bullshit. People strive for home ownership. Rightly or wrongly, it's a symbol of success in our society. I have my own thoughts on the whole keeping up with the Joneses mentality, and frankly, I think it's toxic. But the reality is that home ownership matters to people. So yes, prices coming down is good for affordability. It's good for the next generation. It's good for the economy long term. But as a homeowner, and as someone who represents clients who are homeowners, it sucks. It sucks to see your net worth decline. It sucks to watch your equity shrink. And if you're trying to sell right now, it sucks to realize you're not going to get what you would have gotten a year ago. So it's a double-edged sword. What's good for the market broadly can hurt on a personal level. So let's address the title. It's over. The price increases are over. The crazy multiple offer feeding frenzies on every listing, over. The days of buying a place, sitting on it for 2 years and flipping it for over 30% gain, over. But is the market over? Hell no. Markets are cyclical. We know prices will go back up again one day. The question is when and how long they go before that time comes. Obviously, nobody has a crystal ball, but here's what I know. There will be people who take advantage of this market shift. There always are. And we don't have to look back very far to see. Remember 2015 to 2016? Oil prices collapsed, and from over $100 a barrel to under 30 by early 2016, Calgary's economy, which at that time was heavily tied to energy, got absolutely crushed. Massive layoffs across oil and gas, hiring freezes everywhere, contract workers cut loose overnight, companies slashing capital budgets, a ton of uncertainty about the future. People were terrified. Everyone thought the sky is falling, Calgary's done, get out while you can. And you know what? There were people who bought during that downturn, and they absolutely crushed it. Because when the market recovered, especially post-2020, when rates dropped and migration surged, those properties skyrocketed in value. The question is, would you buy the dip? Because make no mistake, if you're a buyer right now with job security, a down payment, and the ability to carry a mortgage, you're in the driver's seat. You've got leverage, you can negotiate, you can take your time. You can be picky, as you should be. And if you buy smart in a good location at a fair price with a plan to hold for the long term, you're probably going to do pretty well. The labor market will dictate what happens next. And here's the real key. Our labor market plays a huge role in our housing market. Alberta's population growth is still strong. We're still one of the fastest growing provinces, but the latest jobs report shows mixed signals. If the labor market stays soft, if businesses stop hiring, if people lose confidence in their job security, demand will soften further. Prices will soften further, and we could see a deeper, longer correction. But if we get a trade deal, if business confidence rebounds, if hiring picks up, we could see a floor under prices pretty quickly. And when that happens, when sentiment shifts, you're going to see buyers flood back in. Now, I've said that before. I think that there is a good business case in Alberta, and that means that I don't think we're going to see a huge crash in prices. Unfortunately or fortunately, depending on which side of the coin you're on. Well, look, I'm not here to blow smoke up your ass. I'm not going to tell you everything's great when it's not. The market is softer than it was a year ago. Prices are down, inventory is up. Sellers are feeling the squeeze. But I'm also not going to join in the doom and gloom, the market is crashing bunch, okay? Calgary is not Toronto. We are not Vancouver. We don't have their levels of speculation. We don't have their levels of foreign investment. We don't have their supply constraints. And we don't have their price to income ratios. Yes, our market has shifted, but shift creates opportunity. For buyers, this is the best market we've seen in years. For sellers, it's about being smart, being strategic, and working with someone who understands the data. Is it over? No, it's just different. And different isn't bad. Here's the thing, if you're buying real estate and expecting it to never go down, well then you shouldn't be buying real estate. It's the same thing with the stock market. You know, in the short term, there will be fluctuations, volatility in price, but the goal is long term. I'm always here if you have any questions. Call, text, book a meeting in the link below. Thanks for watching. I do really appreciate it, and I'll see you soon.